Hi and welcome to this week's Property Insiders Market Update video. Being the beginning of the month, it's a longer session where we dive deep into the property market data, and you'll be pleased to hear there's more good news than there are bad news. We're going to discuss the latest economic data, the Reserve Bank's decision, how vendor confidence and consumer confidence is improving, what's happening with the number of properties on the market, auction clearance rates, and some great news about the rental markets. So if you're interested in keeping up to date in what's happening in property, why not click the subscribe button so that you get updated every time we bring out our video. And if you click the little bell icon, YouTube will keep you updated as soon as these new videos come out. The media's been busy this week with headlines like COVID crisis triggers the first fall in property prices, the COVID correction begins. And the one that was likely to attract a lot of clickbait earlier this month would have been the headline, warnings of enormous poverty as the banks forecast property market correction. But the negative Nellies are wrong. Our property markets aren't crashing. They're showing resilience. And there are some positive signs for our property market. Australia is coming out of its lockdown earlier and better than expected, and restrictions on our property market are already starting to ease. After a marked fall in March and April, the number of transactions occurring and the properties listed for sale is starting to pick up. Sure, there's bad news ahead, and there's going to be an indirect economic effect of the coronavirus on our property markets moving forward. Things like the lasting damage to our economy, what's going to happen to unemployment, household incomes, consumer confidence. But it's likely that it's going to be less of a bad turn ahead than people expected. There's good news coming out, green shoots as we like to say, and that's what I'm going to discuss today with Dr. Andrew Wilson in our monthly property market update. Of course, Andrew Wilson is the chief economist of myhousingmarket.com.au and Australia's leading housing economist. So welcome, Andrew.
Thanks, Michael. Yes.
Well, Andrew, just before we started recording this session, I opened up my inbox and there was the headline, "We're in recession and worse to come," says Australia's Treasurer. Are we actually in recession yet, Andrew?
Well, no, we're not, Michael. I mean, the official definition of a recession is consecutive quarters of negative GDP, of economic growth. Last time that occurred, of course, it's during that period, 1991-92. But we've just recorded our first quarter of negative growth, down by 0.3%. I thought it was going to be line ball, just above or just below the line, but certainly March, the actual month of March, had an impact on the figures. Let's remember our economy really hasn't been working on all 8 cylinders, more like 4 cylinders recently. And this has just obviously been straw that broke the camel's back, no surprise, in terms of GDP moving below the line. And of course, we do know with just about absolute surety that the June quarter will also be negative, and quite significantly negative as well, given the coronavirus shutdown. So I guess in anticipation of an almost certainty of the June quarter, we are in a recession notionally, but not officially, Michael, not until we get those numbers.
Well, technically a recession is when you've got 2 quarters, but yes, the economy isn't chugging along on 8 cylinders or even 6 cylinders anymore. It's chugging along on 2. And that's really where people are now going to get concerned. So this is about the quarter that finished in March. Let's just make it clear, even though it's June. So we're not going to know the June quarter figures for another 3 months, when it's very likely that the economy will have already started to pick up.
Well, that's right. It's backward-looking GDP data, of course, Michael. We won't get those June quarter results for 3 months into September. And of course, that will coincide with the cliff, which is the end of the job seeker allowance. Given that there was just about certainty that we were going to move into a recession either through the March-June quarter or the June-September quarter, I think it's good to get the bad news out of the way, in a sense. Those recession headlines aren't going to have the resonance in 6 months' time that they have now. We are working on the good news, bad news cycle now. We've seen the better news in terms of the coronavirus shutdown have a definite impact on the housing market recently, with new listings picking up, and consumer sentiment measures have also been quite positive. Now, we will get some response, I would assume, to the recession headline, even though it's not a recession yet, but it does mean that that particular headline will lose its energy now going forward. So in a way, it's better to get it over and done with early, Michael, I think, rather than be waiting around to get confirmation of our first recession since 91, 92. So I guess the question is whether our recovery will start to show signs of picking up over the September quarter. And if it does, that will be a good news story to start the year next year.
Well, as you said, we all were expecting it, whether it starts this quarter,
Yeah.
next quarter. Overall, Australia's economy has slowed down. It'll slow down a bit more, and
Yes.
then it will pick up. It's something we've avoided while it's actually happened around the rest of the world. And the world goes on after a recession, doesn't it, Andrew?
Well, it does, Michael. And just as we've come out of the coronavirus, likely in better shape than just about everybody else, I think our prospects for an economic recovery are also world beating. So it will be interesting to see if this does have an impact on sentiment, Michael.
Well, we're going to have a look at what's happening in the property markets right now. But I agree with you that the barrage of headlines we're going to get is likely in the short term to affect people's confidence. And that's a bit of a pity because there were some green shoots. So let's have a look at what is actually happening in the economy. I'm looking forward to seeing what's happening in real time with your results today, because it seems like Australia is now becoming more optimistic. Consumer confidence has risen for the 9th week in a row this week, according to ANZ Roy Morgan. Now, 9 weekly gains in a row, that's unprecedented. But let's be fair, it was from really depths, bad depths of a starting point. So more good news about Australia controlling the pandemic, relaxation of restrictions, expectations of a housing stimulus. And at the same time, Australians are spending more. There's a bright spot in our economy, as the charts I'm showing on the screen now from the ANZ Bank show. And the ANZ Bank is finding that more of us are spending money shopping, and we're using credit cards more than cash. So, Andrew, there seems to be increasing signs of optimism and hope for the future.
Well, it's all working together, Michael, isn't it? We're all feeling a lot better that the severity of the lockdown of the past 2 months is now easing, and we're looking like getting back to normal in terms of our capacity to move around sooner rather than later. And I think we might even see those state borders that are still closed starting to open up over the next month or so. So we're all in unknown territory a couple of months ago, and of course that means we didn't really know what was to come, and that of course fertilised the usual hysterical speculation in regard to the direction of the economy and of course the housing market as well. But well, I guess there's some gnashing of teeth at the moment amongst those doomsayers, but good luck, guys. What goes around comes around, and this seems to be like Groundhog Day, doesn't it?
We should be optimistic. Look where we are, look where we live at the moment, and look what's happening around the world. So we should be thankful that our government has managed to control coronavirus.
Yeah.
And I think also that the government had enough money in its coffers to be able to invest in a stimulus. And it seems like they've got a little bit more to be able to invest in further stimuluses since they got that job keeper figure wrong. Andrew, this week the Reserve Bank kept its cash rate at the same and the 3-year bond rate target at the same. But no one was really surprised with that. But they seem to also offer some good news. They held out hope that the economic downturn might not be as severe as feared. So the Reserve Bank governor said the outlook, while it remains uncertain, may be better than they'd initially budgeted for.
Well, the RBA tends to have a dollar each way, doesn't it, Michael? And, I don't think their predictions have been, I guess, in uncertain times, we'd expect those, the wavering of the outlook. We've spoken about the issues around September when the JobKeeper allowance is due to expire. And if that's been characterised as the cliff, I'm not sure the cliff's going to be that high, Michael, to be quite honest. I think, as you suggested, the fact that the budget allocations for JobKeeper were a lot lower than first expected, I think means that there'll be some capacity to maintain the JobKeeper allowance. But I do think that it will be targeted, more of a targeted allowance to those that really need it. And I think that's a good thing. And I think that those that were perhaps concerned about their financial prospects going forward and are on the JobKeeper have actually had that 4 to 6 month period to adjust to the possibility of a significant financial constraint to them. And I think that means that they can perhaps be in a better position than they anticipated. And I think that means that the government will still have some funding to be able to direct to those that are still obviously in need of support. But look, I'm not saying that we're not going to have some economic issues, and there are some hard yards to cover, But I do think even that prediction of 10% plus employment might be looking a little bit shaky now, Michael. And I think particularly if we see the participation rate stay at where it is now, I'm not sure we'll see the same significant job losses that pushed up the unemployment rate from April to May. So there's no doubt that we haven't seen any dramatic fall in housing market activity. In fact, the real-time measures are showing a resurgence in confidence in our housing markets, Michael, over the last week.
Well, we'll get to those figures in a moment, but I agree with you that this cliff in September that people are talking about when the mortgage holidays and the government stimulus packages come to an end, I actually can't see that happening either. The government isn't going to have spent so much time supporting the economy and our housing markets to allow that to occur. Maybe the mortgage holiday periods will be lengthened, maybe the stimulus will be lengthened, but more tapered. It's not going to be as widespread. But at the same time, the very low cost of debt, improving consumer confidence, the easing in social distancing, all this is going to mean that our economy is going to start picking up, and the banks don't want to take on mortgagee sales. So I agree with you, there's unlikely to be a cliff that we're going to fall over. There's also various stimulus packages. It hasn't been announced yet, but they keep talking about this $1 billion series of targeted measures aimed at new homes and major construction activity. That's going to come out over the next week or so, Andrew.
Well, yes, Michael, but I'm a little concerned about that. They're certainly talking a big talk at the moment, the government, but I do think that they need to have these policies and push them into the marketplace rather than speaking about them, because it can act to have buyers and sellers in property, particularly, and perhaps builders, postponing decision-making in anticipation of some sort of a policy boost down the track. So let's get those policies out now, fellas, and not create that anticipation of them, which can have a negative effect on activity in the short term.
Let's have a look at what's happening to the housing market. Yeah. So in this monthly update, we go into a lot more detail. Now, even though it's monthly, really going on monthly figures isn't as valuable anymore. The world is changing too quickly for that. But as normally happens at the beginning of the month, CoreLogic's Home Value Index came out and it showed that in the 8 capital cities, property values declined 0.5% in May. That's actually not bad considering all that's been going on, the weak economic conditions, the pandemic, a fall of less than 0.5% overall, shows our property markets have remained reasonably resilient.
Well, that's right, Michael. And again, this reinforces that additional price measures are really backward looking. We have measures available now that give us more of a real-time insight and are looking certainly more positive than they have over recent weeks. But we've got to understand that we obviously had low transaction numbers, low numbers of sales, low listings, low buyers, low sellers over that April to May period. And that meant that, of course, prices declined, particularly given that we had fewer auctions, Michael, and with the auction market actually closing. And of course, auctions typically favour higher priced property. So we've got to also understand that the price mix was different also over May in terms of the number of properties being sold at the higher end of the spectrum.
What about more recent data then, new properties coming onto the market? How are you finding that?
Well, this is a real uptick that we're clearly now tracking, Michael. There's no doubt that the daily new housing listings index has picked up and is gathering momentum over the past week. Latest results show that it's now just around 20% lower than at its base point prior to the coronavirus. And that shows that sellers are becoming a lot more confident in the marketplace, in the prospects of them securing a sale. And I think that's really showing some good early positive signs of a rebound in confidence. And I think that really has good prospects for the market going forward. And we look at the breakdown of the data, Michael, it's clearly Melbourne, Sydney and Brisbane that are picking up extra new listings. And again, it's pushing back towards those pre-coronavirus levels. Now, still some way to go, of course. We are entering the typically quieter winter market. But look, there is momentum there. The smaller markets, Adelaide and Perth, are yet to show that revival. But there's no doubt that sellers are feeling a lot better about the marketplace. And I think that that's reinforcing the sense of growing optimism about the outlook for our housing markets, Michael.
And when they're bringing their properties onto the market, asking prices is another indication of
Yes.
vendor sentiment. And
Yes.
it's a very, very good indication what final selling prices are going to be as well. So how are you finding those trends, Andrew?
Well, again, the price movements are weaker over the month, Michael, marginally weaker. But again, we have to understand that a lot of that can be attributed to the mix of properties coming into the marketplace with really still very low numbers of auction sales. And that, of course, means fewer higher priced properties coming into the marketplace. That's contributed to the easing, but it's only a marginal easing, Michael.
Well, looking at the various housing market asking prices, Brisbane seems to be going ahead in leaps and bounds. And that's what we're experiencing on the ground as well in our offices at Metropole, that even though there's a shortage of properties, and in all states there's a shortage of good properties on the market, people seem to be more optimistic in Brisbane and they're getting back into buying homes, moving homes and investing.
Well, that's right, Michael. And Brisbane is the leader in terms of the new housing index series, the daily series. It's the closest to its prior pre-coronavirus point. I think that just reinforces what you're saying. And also we have detected some price increases over the month in the Brisbane markets. So look, that market's proving to be the most resilient of all the capital city markets, both for price outcomes and for seller sentiment as well.
Another good in-time indicator of what's happening in our market are auction clearance rates. Now, they're not as useful as they used to be because, as you've said a few times, the auction volumes are low, but the auction volumes are increasing. And of those properties going to auction, Andrew, your statistics we're seeing here now seem to show that their properties are selling.
Well, that's right, Michael. We can start to look a little bit more carefully at auction clearance rates now that were really telling us nothing when they moved down to those 30% levels a month or two ago. And that was because of the high numbers of withdrawals. And it does reflect on the methodological approach for auction clearance rates, which count withdrawals as non-sales. And as the auction marketing campaigns now revive, I expect to see more numbers of auctions. And therefore, we can look at those auction clearance rates more closely in terms of what they're telling us about the market.
Well, there's usually about a 5-6 week period between when you
Yes.
decide to sell your property at auction and when it finally goes to auction. There's a couple of weeks of getting it ready for auction, the advertising, the marketing preparation, and then there's usually a 3 to 4 week campaign. So I believe we're going to see more auctions coming
Yes.
up over the next little while, and then it'll be a better indicator, Andrew.
Absolutely, Michael. But certainly the bottom line this week is the news has continued to improve over the last few weeks, particularly reflecting on that, on the seller sentiment coming through, which is on the rise.
Well, there's a common theme coming through. The common theme is things are looking better, green shoots. And that's also happening in the rental market, Andrew. People were predicting there was going to be a fall, a collapse in rents, lots of vacant properties, investors selling up their properties because they weren't getting rents coming in. That's not happening, is it?
No, in fact, it's interesting, Michael. We're seeing these results can be, again, volatile, but we're seeing some signs of an easing in what was a surge in listings or the number of properties advertised for rent. And I think that's a little bit to do with the number of new listings reflecting landlords coming into the market and changeover from tenants. And I think that's been halted because of the support that tenants are getting from the government. Reflecting that, we've actually seen some vacancy rates falling for houses in some of the capitals, and unit vacancy rates remain quite stable. Also, I think that we're starting to see with the opening of borders, perhaps a review from those Airbnb landlords looking towards continuing to have holiday rentals rather than moving into the longer term rental market.
Well, what we're noticing on the ground is there are more people coming out looking at open for inspections for rental properties. More people are comfortable leasing. They're feeling, I guess, more comfortable in their economic circumstances and they're able to move on with their lives. So, yes, even the rental markets are performing well. So overall, we're doing much better than many of the pessimists had. I was going to say hope for, because I think there are people out there who are hoping all this is going to crash. And that's not going to do anyone any good when 70% of properties are owned by homeowners. It's our castle. We need somewhere to live. And I think that's one of the things that's underpinning our property markets, Andrew. That people aren't thinking short term, I'm going to sell up because the world's crashing. This is where I want to live. This is what's happening over there in the outside world doesn't affect what you're going to end up doing with your home.
Well, you're right, Michael. And people forget that a large proportion of the housing market is people who actually own their homes outright and don't even have a mortgage. So whether interest rates are rising or falling or doesn't have an impact on them or the nature of the jobs market in terms of repaying the mortgage, because they own their properties. And as I said, there's a lot of, I guess, hysterical predictions and has been, and we're used to this over the journey. In fact, Michael, we had exactly the same thing a year ago. Let's remember, it wasn't that long ago since we had the same people making the same predictions. And of course, they were wrong again. And those black clouds that were predicted for this year are just looking a little bit more grey than black, are they not?
Yes, they are. That's good news. Thanks for giving us the detailed update on the property markets. And we'll be back next week with our shorter weekly property news headlines and market update. Thanks, Andrew.
Thanks, Michael.